Good morning, Wealth Press subscribers and viewers. Welcome to another Monday Roundtable. Today I've got Jeff Zandaniri, Adam Sarhan, and Roger Scott joining me. Gentlemen, welcome.
Thank you for having us here, James.
Roger, we're going to start with you this morning. You had some interesting comments about the Housing 100 Index. Why don't you give us a rundown of what you're seeing and what it means, what it implies for the week's trading?
Well, I'm going to tell you this. I've been trying to not focus as much or be as narrow focused on the technology sector because the technology sector has been really hot. That's where the money's been. But there's others that are starting to appear on the headline. We've had home sales, and we've had this announced that interest rates are not going to be going up till 2022, maybe possibly higher. So I've started looking at the housing markets, but not just the housing market. I'm always one of the guys, when gold is hot, you look at the guys who are selling the shovels. That's how my mind has always worked. So I'm looking at the home builders and what it can mean for companies that are related to the home builders. But let me give you some numbers. This is very interesting. Home builders, broader housing industry, very bright spot. Big rebound. The Hoya Capital Index led the market this week, showing very strong gains. Mortgage Bankers Associations are now saying we are 16% higher from last year, okay? National Association of Home Builders reporting that jump 14 points from June to 72 in July, barely shy of the record high level of 75 set back in 2019. All three major components, both the current sales, future sales, 75 home buy traffic rebounded to the highest level of home buying traffic on record. Lastly, U.S. Consensus Bureau reports that housing starts jumped 17.8% in June to a seasonably adjusted level of 1.18 million units. Housing permits rose 2.1 to a rate of 1.24 million. Folks, we are seeing record numbers in the housing market. What does that mean? Well, I've got a couple of hot home building stocks that I'm looking at. Now, interestingly, the focus is hot on the residential and complete cold on the commercial sector because the commercial, COVID-19 and so forth. So it's very interesting period. Just like the stock market is extremely fragmented, we're seeing the same type of fragmentation in a narrower focus with home builds versus commercial property. You're having huge uptick and zero uptick here. So you got to separate. You can't just go into all real estate stocks. But I'm really liking some I have a couple of names that I'm looking at in terms of home builders. And I'm also looking at basic material stocks. Basic materials gone up higher than technology over the last 30 days. They've gone up almost 12%. While technology in the S&P has gone up a little over 9%. And what do I mean by basic materials? Sherwin-Williams, painting stock, stocks that supply Miracle-Gro, that supply anything relating to when people start building homes, they start getting into basic materials. So you're seeing home builders and basic materials. I'm seeing a nice little push north in that over the next few months from a fundamental and a technical perspective. For example, DHI stock, MATH stock, the seventh biggest home builder in the country, they are near all-time highs right now. They're doing really, really well. So one sector I believe investors should be looking at is residential home construction and everything else that comes along with it. Wayfair, home furnishings. Stock was near all-time highs last week, ticker symbol W. Again, not just the home builders, but everything that comes with the home builders and also the basic material stocks. I'm seeing a big uptick technically and fundamentally.
That's interesting, Roger. I'm in the midst of a residential construction project of epic proportions myself, and so I can see that. I've been experiencing shortages of everything from S4S cedar for finishing decks to pressure treated basic timber, and so it seems that there's a real vacuuming going on of the materials sector. So that's intriguing. Adam, what's got your interest this week?
Sure. So what Roger said is right on the money. I have an investment firm where we buy houses and fix them and renovate them, all that fun stuff. And we bought a place in February right outside New York City in the suburb. And even with the COVID shutdown, we renovated it, fixed it up, all that fun stuff. We bought it for 450. We just sold it for 899 or 900. And it's just record demand. Mortgage
Wow.
rate, a 30-year mortgage is at 2.98% to get a mortgage. 2.98. If anybody remembers back in the day, you're at double digits. So, or even very high single digits. So even before the '08 crash back in '05 and '06, during that housing bubble, the mortgage rates were low back then at 5.75. I remember in
Mhm.
2005, I got a mortgage. I was really happy at 5.75%. Today, we get mortgages at 2.98%. So the housing market, Home Depot, Lowe's, everything that Roger just said is right on the money. I have a term that I call the great mini rotation. On Wall Street, there's a term called the great rotation out of stocks into bonds or whatever the case may be. So under the surface, I call it the great mini rotation, which basically means money flows out of a really hot sector into an undervalued sector. That becomes overvalued or a little bit hot, and then it rotates into another undervalued area, so on and so forth. So in addition to the home sector and the housing stocks, I also like gold and the gold stocks. If you look at GLD, which is an ETF that tracks gold, it's doing exceptionally well, multi-year highs, so on and so forth. But the GDX and the GDXJ, which are basically the gold miners, are lagging and underperforming, which usually means that the gold miners are undervalued and they're going to rally to catch up with gold.
You bet. Well, I'm with you on that one. I've been accumulating gold stocks here for the last 6 months, and yeah, I'm still waiting for that great pop. Jeff, I think you might remember a few weeks ago we talked about the timing of exposure to gold, and you were, as a guy who focuses on capital efficiency and opportunity costs associated with being too early, you've been patiently waiting for gold to sort of trigger your interest, and people like you who prefer to keep their capital in hot sectors. Has the gold market, in your estimation, moved any closer to that target?
It has. I'm back. I got back in last week. I expect big things. I expect, so the market's kind of like this thing that's almost like designed to confuse people. Every time people get complacent with something being the reality, something else happens. And so we've been in this like kind of sideways consolidation period for the better part of a month and a half. Gold's kind of consolidated while stocks have been bid, which is strange. And I expect volatility to pick up dramatically here soon. A lot of the excitement over the reopening has been priced in my estimation. There's been super positive news on the virus vaccine front, which I believe is largely priced in. So I think a lot of smart people, a lot of people that command huge dollars expect a vaccine by this fall, this winter. So I don't think that's like going to be like a big upside surprise for anybody. What I'm focused on this week, though, is tech earnings. Last week we had financial earnings, and this week is a lot of tech earnings. We have Texas Instruments, we have Microsoft, and we have Tesla. And we saw, everyone likes to focus, is my company going to blow out numbers? But what people don't really understand that you should really be aware of is what's the environment like for all companies and earnings right now. And last week we saw unbelievable beat in something Roger and I have been discussing and tracking in the investment banks. They crushed their trading numbers. Morgan Stanley, for instance, was supposed to make $1 billion in fixed income commodities trading. They made $3 billion. And so these are the kind of things happening in the trading world. It's, huge upside beats. But Wells Fargo, who has huge exposure to borrowers and commercial savings and loan type of activities, got crushed. They had a horrible number and their stock was destroyed mercilessly. But Morgan Stanley, who crushed on the upside, didn't get the same kind of upside love. So if you contextualize that, you say to yourself, well, companies that are missing are getting taken out back behind the woodshed. And companies that are crushing and beating, well, that's kind of been baked into the cake a little bit. They're not getting super love. So we saw that with Netflix also. Netflix had a huge low subscriber metric that came in, and stock got whacked. So I watch implied volatility, what the expected move is the day following earnings, and they're increased for everybody. Tesla, for instance, in the past averages about 9% move we're expecting a 15% move in Tesla the day after, so Thursday, because they report Wednesday after. Microsoft usually moves about 2.5% the day after they report earnings. This time they're expecting 5.5%. So it's just something for people to consider if they have these stocks in their portfolio. Earnings are going to really be what moves the markets, and the biggest ones are in the middle of the week. We also have Texas Instruments and Intel for you semiconductor lovers out there, but something to pay attention to.
Just something I wanted to interject, which is right on point with what Jeff is saying. He mentioned tech earnings, and this is the week that things get really hot with tech earnings. Seeing for a couple of numbers for investors to pay attention to. The current expectations, what's all said and done with tech, is after everything's been revised lower, it's down 12.7% on 1% negative revenue. So negative 12.7% for the quarter on negative 1% revenue. Last quarter, we had positive 3.8% on 4% positive revenue. So basically, if 3 weeks from now or a month from now, maybe even less because the big ones are coming out now, we find out that they're averaging less than 12.7%, where we may see some disappointment, selling pressure, whereas if the number's better than the 12.7, we may see some upside. But that's the golden number investors should be looking for. I just wanted to mention that because Jeff mentioned tech earnings. The golden number to look for is negative 12.7%. That's what Wall Street is pricing into value as we speak.
Okay. Can you just wrap some more color around that, please, Roger? There was a bit of a breakup from where I was sitting here.
Oh.
And so you're talking about 12.7% annually?
Yeah, from a quarter from a year ago, a year ago quarter.
Okay.
Yeah, and basically you have analyst firms revising these numbers, and they keep revising them, and they keep revising them, and it's like a moving target with revisions. And what I look at is I look at the consensus. So the consensus right now, expectation on Wall Street right now over the next month or so, the majority of these large cap techs, as Jeff mentioned, Texas Instrument, Netflix. I'm sure you've mentioned some other ones. I was just writing the numbers down while you were talking. I heard several stocks. The consensus estimate right now is negative 0.7% from a year ago. Okay, this quarter a year ago, whereas last quarter from a year ago we got positive 3.8% on 4% positive revenue. We're now expecting, this is supposed to be the bad quarter, the trout. We're expecting negative 12.7% on negative 1% revenue. So the point is, markets are always anticipating or pricing in these expectations into their value, especially tech right now. So if you see the number negative 8%, for example, versus negative 12.7, you can expect a little upside. Whereas a month from now, we find out that the actual number is negative 14%, you can expect a little downside. The market always prices in ahead of time these expectations, these broad expectations. It's like when you see an employment report, even if it's bad, but if the number is better than the expectation, the market will rally. So again, I'm just throwing out the expectations so everybody knows what that target level that we're looking at right now, beat, meet. It's kind of like a moving target, but at least we have some idea of where we stand and what's better or worse. So I never look at the number in an absolute way, like in other words, well, it's negative 12, so it's bad. No, negative 12 is already priced into the market. So if it's better than negative 12.7, we may expect a little upside. If it's worse than negative 12.7, we're going to see maybe a little more fallout, a weakness from the tech. But the target right now, the expectations on every radar is negative 12.7% over the next few weeks, month, while the majority of the large cap techs get squared out in the S&P 500. And this is the expectation for the tech sector in the S&P 500. So there's 50 stocks there, and all the usual suspects are there, all the big caps.
Okay. I'm a WealthPress subscriber, and I'm sitting at home watching this, and I'm hearing that gold is good, real estate, homes are good, tech has got some great moves coming, and now I'm confused. What should I be doing as a WealthPress subscriber? I mean, it sounds like I've got an embarrassment of riches here. I don't know what to do. So what's the bottom line here for this week's trading activity? And I'll start with you again, Roger, just because it's like you got the data there at your fingertips.
No problem. Basically, and I'm just continuing what I started off last week. I told everyone who would listen to me that this was a Tuesday. Moderna announced Tuesday that they're doing huge trials now. As soon as we saw that, there was a major factor impacting the stock market. The technology sector started cooling off. As Jeff coined it, the stable premium sector, it started cooling off, and the blue chips, the ones that have been lagging behind, started coming up a little bit. Now, with that, we've started seeing a minor change in the characteristic of the market. When I saw that beginning, I said, hey, folks, it's probably best right now to get out of technology individual stock and to shift into technology mutual funds. If you recall, I gave you a bunch of symbols last week. Clean energy, I believe Friday, clean energy, disruptive technology, cloud computing, which is right now making all-time highs, by the way. ACES, I believe. So the point is, I'm becoming a lot more defensive. I'm moving a lot more into gold, as Jeff agrees. I'm moving a little bit more into basic material and home builders. So gold, interest rates, more conservative sectors, and I'm not completely getting out of the technology stocks, but I'm becoming aware that there's a greater volatility risk there. So I'm trying to have my cake and eat it too. And so I'm willing to take the profits that I've been gaining out of my technology, because I've been listening to Wealth Press and been very bullish on technology stocks, and they've been making us good money. So what I would do is I would take those profits and I would diversify them into a handful of those ETFs, because you're going to have wider exposure. Wider exposure means less volatility. Less volatility means less risk. So I would spread my portfolio out, whereas I was concentrated in technology and in individual technology stocks in the past few months. Now I am exposing myself more broadly to gold, interest rates, basic materials, and home builders, and then still taking a chunk of the prop from technology and putting them into those 4 mutual funds I mentioned last week. I'm diversifying and spreading my risk more right now, because the market is at a higher risk point than it was a month or two ago, in my opinion. Plus, earnings give us volatility.
Sure. Okay. And Adam, what would you say to the Wealth Press subscriber at home with a bit of capital to spread around this week?
Sure. So I would say, remember the old novel in the 1800s? Charles Dickens had a book called The Tale of Two Cities.
Mm-hmm.
I take that and I say, okay, it's a tale of two markets, or two tapes, if you will. And what that basically means is that bifurcated market, nice big fancy word, which means there's 2 kinds of markets under here, like we spoke about last week: the stock market and then a market of stocks. Understand where your stocks have gone in the last 6 to 12 months. Ask yourself what's going to happen going forward, because that's all that matters, is to the right of the last tick or the right of the chart. And then ask yourself, as you go into earnings, do you have a cushion? If you have a cushion, in other words, if you're up 30% or 50% or whatever the case may be, then you're able to sit through some volatility on the downside. I mean, the stock could pull back, like Netflix. I own that, full disclosure. I'm up over 80% in it, and the stock fell 10% last week. Still above support, still above all the technical levels I watch. Fundamentally, the thesis is there. The stock, when you dive in deep, they missed earnings because of a one-time non-cash event, which isn't going to happen again. And they lowered guidance because of Roger's point. They want to play the expectations game. You've seen Apple do that before, Amazon, all of these high-flying stocks. It's a game of expectations. If I tell you, hey guys, you're my friends, let's go watch this movie. It doesn't matter what the movie is. It's the best movie in the world. You're going to love it. And then it's a good movie, but it's not great. It doesn't beat, it doesn't beat the expectations, because I talked it up and it's the best thing in the world. You're going to walk out like, Adam, you know what? It was a good movie, but it wasn't the best movie in the world. If I tell you guys, listen, you don't want to go watch that movie. It's awful. It's horrible. And just lower those expectations all the way to the ground. And it's a decent movie. It's okay. You're going to be happy. Why? Because your expectations going in, everyone's smiling because I'm sure you've experienced this, are super low. And companies do this all day, every day. And just like word of mouth is the best, compliment you can give somebody, it's the same thing from an investing standpoint. These companies that have these high-flying stocks, they're very, very aware of the fact that it's an expectations game, and they play the game all the time. So Apple, in the last 12 years, 13 years, has been notorious for doing this quarter after quarter after quarter. They beat numbers, they blow away expectations, but then they lower guidance, and the stock goes down a little bit for a few days or a few weeks, and then boom, it takes off again. Because once the market realizes what's happening, then the price comes back in, buyers show up, and everything's fine and dandy. So ask yourself where the cushion is. Ask yourself, where do you want the market, your stocks to be positioned into earnings, and ask yourself that tale of two tapes. Where do you want to be?
Under promise and over deliver is communication strategy.
I guess it was the best of times and it was the worst of times, right, Adam?
There you go. Exactly. Exactly.
Great. So Jeff, what would you say to our WealthCrest subscriber at home looking to deploy some capital?
I would tell them, first and foremost, this is actually a teachable moment, because you triggered something in my mind where you said, yeah, you're talking tech, but you're talking gold. Both things can be true. I can be bullish on gold and I can be bullish on tech. I know you're used to being sold on it's an either or scenario, but in fact, we're in a situation where it isn't. This is not the past. This is not the traditional asset relationships we're seeing. They don't have to stay consistently the way they were in 1986. We're dealing with a specific scenario now of money destruction, if you will, and few things for all this money creation to chase, and just be in the stuff that they're chasing. It's going to continue. It's going to continue. I'm looking at all these things. I had a call with a guy that wants to be a trading helper for me. And he's like, well, Jeff, I see you trade pairs, you trade links, and you trade these pairs, long, short. Are you trading these things expecting mean reversion, which means that they come back together? And I said, au contraire, I expect the blowout to continue. Would Apple and BlackBerry ever reconverge? Is Amazon ever going to be as cheap on a PE basis as Bed Bath & Beyond? Never happens. Those things continue into infinity. What I try to do is to be tactical about getting into them and out of them. So when you ask me, why, what do you think about gold? The trigger came back and I'm back in it. I'm happy to be back in it. But it's going to take a lot for me to be bearish on gold, because the fundamental thesis is the same way. Same way I'm not going to just, and Adam said the same thing with Netflix. When you have a good thesis and you have a good case, even if you miss a quarter, even if you have like this hiccup, that doesn't mean you become pessimistic and short it. So both things can be true. You can own tech and you can own gold simultaneously, and just be tactical. And another thing, you don't have to kick out your whole position. You can take a little bit off. One thing I love to do, and this is a common psychological thing that happens to traders and investors. Holy crap, I made too much money. I'm just so uncomfortable. I want to book this trade. So the first thing you have to learn as a trader is to cut losses. The second thing you have to learn is how to sit in winners. And one good habit to sit in winners is peel a little bit off of it, just to be tactical. Take a quarter of your position off. And then the other 75% of your position, you can say, well, if we get below the 200, use whatever metric, whatever technical indicator you like, and say, well, if we have a retracement to this, I'll kick the whole thing out. You will be shocked how much further the trend will go than you thought it would go. And you'll be making money the whole time. So I just wanted to use those little tactical observations for the week.
All right. Well, that's great, gentlemen. Let's leave it there for now. We're about 30 minutes in, and have an excellent trading week. And I'll look forward to speaking with you each individually throughout the week. Thanks for joining me today again.